Hey everyone, I'm Sean with The Modest Wallet, and today we're going to be talking about 8 tips for beginning investors. Now I get it, if you're on YouTube or other social media platforms, you're probably being bombarded with get-rich-quick schemes or maybe even do this, do that in order to make money fast.
You've heard of other get-rich-quick schemes.
That is not at all what this video is about. My goal is to share 8 tips, 8 actionable tips, no matter where you are in life, that will help you maximize your investing potential and future and build long-term wealth. If you're not already a subscriber to our YouTube channel, then you should consider and just click that little bell as well so that you get notifications every time we release a new video. Our goal with The Modest Wallet is to share actionable content to help you make smarter financial decisions. This is so you can worry less about money and spend more time doing the things you love.
Why do all the things I love go away?
But before doing the things you love, let's get into our 8 tips for beginning investors. The first tip for a beginner investor is to maximize your 401k. If your employer offers this 401k, you should absolutely use this tax-advantaged account for retirement instantly. The main reason is that your 401k is an excellent tool to invest in your golden days of retirement. The way a 401k works is that every dollar you contribute to your retirement plan until the annual limit of the IRS will be deducted from your income when filing your taxes. This will further reduce your overall tax bill and grow your retirement cushion. Although your employer decides on the plan provider, you will be the one to determine the investment vehicle, the amount of risk taken, and your contributions. Besides that, some employers offer to match contributions by 50% or 100%, which can significantly increase your account balance. So if you haven't maxed out your 401k contributions, and you can, you definitely should. Our second tip for beginning investors is to maximize tax-efficient accounts like IRAs. Tax-advantaged accounts like IRAs and 401ks have annual contribution limits. For 2021, you can contribute up to $6,000 a year for IRAs, or even $7,000 a year if you're older than 50. With 401ks, you can contribute up to $19,500 or $26,000 if you're 50 or older.
A lot of money.
Because of the tax benefits, it would be ideal if you could hold all your investments in tax-advantaged accounts like IRAs and 401ks. But due to the annual contribution limits and lack of flexibility, that's not practical for every investor. Tax-advantaged accounts are typically tax-deferred or tax-exempt. Tax-deferred accounts, such as traditional IRAs and 401k plans, provide an upfront tax break. You may be able to deduct your contributions to these plans, which provides an immediate tax benefit. You pay taxes when you withdraw your money in retirement, so the tax is deferred.
Yeah, and I deferred you 25 years.
Tax-exempt accounts like Roth IRAs or Roth 401ks work differently. Contributions to these plans are made with after-tax dollars. Because of this, you don't receive the same upfront tax break that you do with traditional IRAs or 401ks. However, your investments grow tax-free, and qualified withdrawals in retirement are tax-free as well. That's why these accounts are considered tax-exempt.
Then they'd be tax-exempt.
Deciding whether a traditional or a Roth IRA is for you depends on the tax bracket you think you'll be in retirement. Our third tip for beginning investors is to invest for the long term. The golden rule in the world of investments, especially in the stock market, is to invest for the long term. This is because the financial markets will rise and fall throughout the year, meaning that the value of your investment will follow suit. No one likes that bumpy road. But by staying firm and holding on to your investment in the long run, you will avoid the need to worry about short-term volatility. Of course, there is no guarantee that your investment will recover from a market downfall, but over time, the stock market has historically moved in a long-term direction upward. A great example of this is the S&P 500 index, which has generated average annual returns of over 10% since its inception in 1926. That's almost 100 years of solid data.
Solid.
The key point to remember for this tip is that long-term investing almost always outperforms the market when investors try and time their investments. This is the reason you should be a long-term investor. Emotional trading tends to impact returns. My fourth tip for beginning investors is dollar cost averaging. One of the best tips to consider when investing is to employ a dollar cost average strategy. The main concept of this is that you will look to make regular investments as opposed to a lump sum. In doing so, you will purchase your chosen asset at a different cost price on each investment. In other words, you will be averaging out your base cost price. The goal of this is to really get rid of or remove the need to worry about short-term volatility. Let's take a look at an example of this. Let's suppose you have a lump sum of $12,000 to invest. You decide to put all your eggs into one basket by purchasing $12,000 worth of Tesla stocks at $1,000 a share. 12 months later, Tesla stocks have declined to a price of $800. This means that you will only break even when the value of Tesla stock returns to $1,000, and when or even if this happens remains to be unseen. Now let's see what a risk-averse investor would do when dollar cost averaging. You decide to split your $12,000 investment over 12 months. In month 1, you purchase $1,000 worth of Tesla stocks at $1,000 a share. In month 2, you purchase $1,000 worth of Tesla stocks at $500. And in month 3 and 4, you repeat your $1,000 investment, but at a cost price of $500 and $500. At this stage, you have made 4 $1,000 investments into Tesla at 4 different stock prices. As per the example that we've already mentioned, your cost price so far is $571.43. This is crucial, as had you invested the full lump sum into Tesla, you would have been stuck at a cost price of $1,000 per share. But by dollar cost averaging, you are turning a market slump into a positive. This is because as the stocks decline, you are entering the market at a cheaper price. As such, over time, you are riding out short-term volatility. Wow, that was a long example, but a good one. Let's get into our fifth tip for beginning investors, which is diversification and rebalancing. Perhaps one of the most important tips to consider is making sure that you are well diversified. This means that you spread your investment capital into different assets, markets, and economies. The example we just mentioned about Tesla is the complete opposite of a well-diversified strategy, as you are putting all of your eggs into one basket. Instead, you would be better off investing lots of different stocks from varying sectors and industries. You could also take things one step further by also investing in other asset classes such as gold, bonds, or REITs. The overarching benefit of diversifying is that you are covering several potential outcomes. For example, if the stock markets are down, then it is hoped that your investment into gold and bonds would help counter some of those losses. Additionally, rebalancing your portfolio is also really important. This means reassessing your chosen investments and evaluating whether they still align with your long-term financial goals. If not, you might decide to add, remove, or replace some of the assets in your portfolio. The sixth tip to beginning investors is to keep fees low. Regardless of the asset you wish to invest in, certain fees will be applicable. This is because you need to use an online broker to access your desired market. With this in mind, it's best to choose a platform that has low commissions or maybe even 0% commissions.
I work on commission, okay?
Also, keep an eye out for ongoing fees. This will certainly be the case when you invest in ETFs, index funds, or mutual funds. After all, the provider in question will need to require a fee for managing your money. The seventh tip for beginning investors is to start with index funds. If you have virtually no experience or understanding of selecting investments, it might be best to stick with index funds.
I have no experience.
For example, through a single investment into the S&P 500, you'll be diversifying across 500 large cap US listed stocks. You can do this through an ETF provider at super low fees. Alternatively, it might be worth considering a mutual fund. In a similar nature to an ETF, the mutual fund will manage your capital. But mutual funds are actively managed, meaning they will look to outperform the market as opposed to simply tracking it. Ultimately, by investing in an index fund, you invest very passively. Investing this way still allows you to use some of the strategies we've already mentioned, such as dollar cost averaging and diversification. The eighth and final tip for a beginner investor is to start early. You might be tempted to try and time your entrance into the financial markets, and I fully get that given the markets are at all-time highs. However, there is no time like the present, especially if you are looking to invest in the long term through a dollar cost averaging strategy. The younger you start, the more time you will have to build wealth and take advantage of the power of compound interest. Just to remind you, that's the addition of interest to the principal sum of a deposit, or in other words, interest on interest. Investing early is the most efficient way to take advantage of the amazing reality of compound growth. I'll leave a link in the description of some brokers you can use to get started on your investment journey now. The world of investing can be quite complicated, and I hope these 8 tips provided a small glimpse of that. I'll leave the 8 tips for beginning investors on the screen for you now, but know that we have created chapters or timestamps for the video in the description so that you can easily go back to specific investing tips in the future. With that said, be sure to check out our other videos about investing. I'll leave a link or card above so that you can click on that and it'll take you to some other videos that we have related to beginner investing. Also, leave a comment below what you think is the most important tip that we went over for beginner investors. They're all so important, but what really stood out to you? Thank you so much for watching. Don't forget to share this video with others as well, especially if you think there's someone out there who is just starting to think about their financial future. Lastly, don't forget to follow The Modest Wallet over there on Instagram, and I'll see you over there.